Based on where we are today, I think the next 10 years are going to be difficult. Now, that doesn't mean you're not going to make money. So the stock market is off to a hot start this year. It is currently January 24th, and the market's up big time. Now, if you're new to our channel, I want you to continue watching. We have a different outlook on stocks than most people. When stocks are down a lot and eventually go further, we will have a different outlook than most people. When stocks were up a ton the last 2 years, we had a much different outlook than other people. We were told we were wrong, you were stupid, you don't get it, times are different. Well, maybe not so much. So I want you to watch the entire reason why we think stocks have further to fall in this video. It's not just about, oh, I think stocks are going to fall. It's about your process as to why you believe that. Just like when we believe stocks will go up in the future, we will have to have the exact same logic, but obviously to be able to show, it's easy to make a guess. Oh, well, I think stocks should go up. Well, okay, great. Now, I'm not saying that stocks will be up or down this year. I have no idea. And anybody who guesses is purely doing that, just a guess. Well, we sit there as we look at long-term valuations and decide based on where we stand today, how does the long-term future look? Based on where we are today, I think the next 10 years are going to be difficult. Now, that doesn't mean you're not going to make money. Just pump the brakes there before you get worried. You can still make a lot of money in a down or sideways market. It all depends on how you invest. So what we're trying to do is teach a process, not just give you the fish. We're trying to teach you how to fish. So first off, I have the stock market to GDP ratio that I created myself. And our users of our software get daily update on this stock market to GDP ratio. All right. And you'll get more information on our software here in a few minutes. But as of yesterday's close of 4,019.81, this goes back to 1929, our current ratio is 1.563, which shows an overvaluation of 68% on the nose and fair value of 2,400. Now, does this mean that stocks should be selling for 2,400 today? No. Look back in the past. Look back, going back here. Stock market valuations were lower, were overpriced, but still increasing as time went on. This is why you can't guess where the market's going to go. You just need a dollar cost average every single pay period, month, quarter, year, whatever it is, because as time goes on and GDP increases, the stock market's fair value is going to increase as well, right? So at 68% though, it is off of its highs of last year of around 104%. I think this is quarter end. I think we got to 107%. Now, the average over 10 years is 6.6% return, not including dividends. When you're undervalued, your average is 9.3. Makes sense. The less you pay, the more you return. When you're overvalued, the average is 2.3. Again, makes sense. The more you pay, the less you earn. When you're 30% overvalued or more, the average is negative 0.1, and we're currently 68%. Now, to make it, to put it into perspective here, in 2000, which most people consider the worst stock market of all time, we never hit today's numbers. This is the worst of 2000 bubble. We're not even at the peak of the 2000 overvaluation bubble. And look how stocks did for the next 10 years in that time period. All negative. All negative, except for one, when we were 21% overvalued. Are these the kind of returns you want? Something tells me it's not. So that's one reason why we believe stocks will have a hard time in the next 10 years. Now, does that necessarily mean that stocks will go down? No, not necessarily. Remember, there are two metrics here that are important. GDP and the stock market cap. They work together. As GDP rises, your intrinsic value of the stock market, your fair value, is going to rise with it. The question you need to ask yourself is it more likely that GDP skyrockets to make fair value on the S&P zero, or is it more likely the S&P falls? Or is it a combination of both? So let's see right here. In order for the stock market to be fairly valued, for this over-under to be zero, GDP has to go up to, is it 45 trillion? A little bit less. 43 trillion, call it. And we're currently at 25.7. That is an increase of 70%. I don't know. So let's call it 60%. So how long did it take the stock market to go up, the GDP to go up 60%. Well, that would have taken us to about $14 trillion. Is that the right number? That took 2009. So what's more likely? In the next 13 or 14 years, that stocks stay flat and GDP goes straight up? Or is it more likely that stocks fall down as GDP goes up? That's another reason why we think stocks are going to fall. For the next minute, I'm going to explain to you our software at everythingmoney.com and how you can use it to retire with more money than you thought possible. Do you get anxious every single time the market dips? Do you feel like maybe you're behind on your savings? Is it ever a worry that you may not have enough money to retire? If you've answered yes to any of these questions, then our software is absolutely perfect for you. With these easy-to-use tools and our community with thousands of other like-minded investors in there, you can use all of this to have better peace of mind and to understand why you are making the decisions you're making, because it's more about the emotion and temperament than it is about the numbers. And these tools, especially this community, will help you realize that and make better decisions going forward. You will absolutely be able to understand financial statements and impress your friends who still waste their money buying stocks based on their emotions and other hype people out there. So for a little over $1 per day, less than a cup of coffee, eliminate that fear from your life of worrying about your future financial state and your retirement savings, and try our software risk-free for 30 days. If you don't like it, email us, money back guarantee, no questions asked. Go to everythingmoney.com, sign up now, and change your financial future starting today. Another reason why I'm still hearing people defend the hype things, the NFTs, the Bitcoins, the Tesla stock, Coinbase, all these companies and investments this is too much. I believe that crypto and Tesla will be the poster child of this crash. Tesla's already down a lot. It's rebounding now nicely. I get that. But I believe these were the poster children of this bubble. Why? Because everyone was an expert in it. There was lots of fraud in crypto. There's proving out to be a lot of fraud. How many bankruptcies have happened in the last year? All these things are very, very reminiscent of stock market bubbles. The same thing we saw in 2000, the same thing we saw in real estate in 2006, 7, 8. You saw more fraud. You saw the average person getting into it, becoming an expert. That does not happen. Now, speaking of 2007, 2008, the most famous person to come out of that mess was Michael Burry. This is the guy that The Big Short book and movie were based on. Look at what he tweeted just 10 hours ago. And by the way, if you want to follow me on Twitter, here it is right here. I'm sure they're going to pop it up. Michael Burry said, maybe. I think it's a question mark. Maybe it's a statement. This is from the dot-com crash. Oh, we're fine. We're fine. Okay. I believe this to be true. This is, if you've seen me on this show do it before, I do a chart showing, this is a very famous chart overall. I think we're in somewhat of like this period right here. Still. Or, I've done this before, it might be like this, which is actually what happens. Right? And maybe we already did this, we rebounded, we already did this, we rebounded. Stocks don't go straight down. Stocks have their rebounds, their dead cat rebounds, as they call them, dead cat bounce. They just happen. I don't believe that we're out of the woodwork yet. At the end of the day, in the long run, the stock market is a weighing machine. In the short run, it's a voting machine. And the last 3 weeks have been a major upvoting of stocks. Everybody's been loving stocks again. Okay, we're good. People get sucked back in. You look at Coinbase, it went from somewhere in the 30s to 55. ARK Investment went to from 29 now to high 30s. Oh, we're good. We're not good, guys. Because in the long run, we're still overpaying for stocks. Before, the justification was 0% interest. Now, what's the interest rate? It's up to 4.5%. And my argument when rates were 0% were, guys, if rates are going to be 0% forever, sure, this can make sense. But does anybody really believe rates are going to be 0% forever? Just like if rates went to 15% today, do I think they're going to be 15% forever? Absolutely not. We still have the fundamental problems with valuation in this economy. Right now, the economy is booming, so profit margins are very, very large. Eventually, profit margins have to go back to their normal average in time. And when that happens, earnings per share will decrease, and that'll make the valuations even worse. I'm going to go back to this till I'm blue in the face. Our stock market GDP ratio. We have to have a point. Here's what I predict. by the bottom of this whole mess, this fair value will end up being around 3,000 and stocks will be under 3,000. S&P will be under 3,000. How's it going to go in I have no idea. And this is purely a guess. It could be 3,500 fair value. My whole point is whatever fair value ends up being at the bottom, stocks will be below that. And I'll be here on this channel saying buy stocks because they're going to be good for the long run. And the people in the videos will be saying, you don't get it, you idiot. Stocks are dead. Those same people are the ones today telling me, you don't get it, you idiot. These stocks are going to go to the moon. Okay, sounds good. And I'm fine with that because I realize in order to be a good investor, you basically have to be looked at in the public as always being wrong. And that's the hard part about investing. It's not the numbers. Our software is wonderful. It gives you all the numbers, all the tools you need to be successful investing. But this is the most important part, the chat community. Because this is where the like-minded investors talk every single day about being different than the crowd. That's the important part. You have to sit there and be able to be different. Thanks very much. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?